show this video to more people and tells me these deep dives are worth making. For those who are committed to this journey of knowledge, return to lessons to sharpen their minds after the inevitable setbacks of the market. Your support is the fuel that keeps this channel going. Let us first examine the first half of the fatal equation, winning small. The amateur speculator, having finally entered a correct and profitable trade, is not filled with the calm confidence of a man whose judgment has been proven right. He is instead filled with a sudden and overwhelming fear. He sees the small green number on his ledger, a fragile and fleeting paper profit, and he becomes terrified that the next tick of the tape will erase it forever. His mind is consumed by the thought, I must lock in this gain before it disappears. He is a victim of one of the most insidious and misleading pieces of Wall Street wisdom, the old adage that whispers, you never go poor taking profits. Livermore knew this to be a dangerous half-truth. He counted with the conviction of a man who had seen its consequences 1,000 times. No, you don't. But neither do you grow rich taking a 4-point profit in a bull market. The mindset of taking a small profit is the mindset of a man who is content to earn a clerk's wages in a game that offers a king's ransom. It is an admission of fear, a lack of the courage and the vision required for great success. This fearful impatience is the enemy of all great speculative campaigns. The big money, the life-changing money, is never ever made in the small day-to-day fluctuations. It is made, Livermore discovered through a lifetime of study, by identifying a great primary trend and having the courage to sit tight. He stated it as the most important and most difficult lesson of his entire career. It never was my thinking that made the big money for me. It always was my sitting. Got that? My sitting tight. The impatient amateur cannot sit. His nerves will not allow it. He is a sprinter in a marathon, and he is destined to exhaust himself long before the finish line is in sight. He will see a great bull market. He will correctly identify a leading stock, and will even time his initial entry with skill. But he will sell out for a pittance, for a quick and easy gain that satisfies his immediate need for action and certainty, only to watch in agony as the stock continues its relentless 100-point march to the heavens without him. The great story of Old Turkey, the wise trader Mr. Partridge from Reminiscences, is the ultimate antidote to this sin. While the younger, more impatient traders in the office were frantically buying and selling, snatching small profits on every minor rally, the old man would simply hold his position. When urged by a well-meaning friend to sell his stock and take a handsome 7-point profit, he simply shook his head and said, with profound and simple wisdom, my dear boy, if I sold that stock now, I'd lose my position, and then where would I be? What he meant was that he was in perfect harmony with the great primary bull trend. To sell now, to jump out for a small gain, would be to abandon his alignment with the market's most powerful force. He might not be able to get back in at such an advantageous price. He knew that the real prize was not the 7 points he had now, but the 70 points that the great trend was still to offer. He had the intelligent patience to sit tight because, as he so often reminded the others, well, you know this is a bull market. Livermore learned from men like Partridge the supreme importance of respecting the duration of a major trend. His method was to sit tight and let the great wave unfold. But one of his great contemporaries, William Gann, took this concept of time even further. While Livermore read the tape to feel the trend's health and duration, Gann attempted to forecast it with mathematical precision, believing that market cycles were governed by a natural vibratory law. He sought to find the hidden order in time itself. To understand this fascinating and different approach to market timing, we invite you to explore our new channel, William Gann Trading Insights. The link is in the description below. The lesson from Old Turkey was a turning point for Livermore. He finally understood the great mistake he had been making. The desire to take a quick profit to cash in on a small move was not a sign of prudence. It was a sign of fear. It was the mark of a man who lacked the courage of his own convictions. A profit, Livermore realized, is the market's own validation that your judgment is correct. To abandon a position for which you have such powerful, tangible proof is an act of strategic folly. The 90% lose because they are afraid of winning big. They are so conditioned by their small, fearful mindset that they cannot comprehend the scale of a true primary move. They are content to scalp for pennies in front of a steamroller, and they are inevitably crushed when the great primary trend, which they have so timidly traded, finally reverses. Their profits are always small because their vision is always small. This is the first and most tragic half of their losing equation. Having now dissected the first tragic half of the losing speculator's equation, the fearful, impatient act of winning small, we arrive at its dark and devastating counterpart. The small 4-point profits, snatched with such nervous haste, are never enough to build a fortune. And they are, with a tragic and mathematical certainty, always and completely annihilated by the second half of the equation, losing big. This is the great catastrophic blunder that keeps the 90% in a perpetual state of poverty. It is the single ruinous mistake that ensures that for every one step forward they take, they will inevitably take 2 or 3 or 10 steps back into financial ruin. The amateur speculator who is so frantic and impatient to cash in his small profit, now, when faced with a loss, displays a level of patience that would be the envy of a saint. The same man who could not bear to sit with a winner for more than a day will now sit with a loser for weeks, for months, his capital and his spirit slowly but surely bleeding away. He has committed the greatest and most fundamental of all psychological errors. He has allowed hope to enter the speculative equation. Livermore knew, with the chilling certainty of a man who had been bankrupted by it, that hope is the speculator's deadliest enemy. In every other human endeavor, hope is a virtue, a source of strength and resilience. But in the cold, impersonal, and mathematical world of the stock market, hope is a poison. He wrote, "In speculation, when the market goes against you, you hope that every day will be the last day, and you lose more than you should had you not listened to hope." It is this hope, this desperate wishful thinking, that keeps a man chained to a proven mistake, that convinces him to hold on to a losing position long after the market's own clear verdict has been rendered. This brings us to the most infamous and destructive of all speculative sins, an act born directly from this poisonous well of hope, the act of averaging down. A trader buys a stock and it goes against him. The market is telling him with perfect clarity that his judgment was wrong, but his ego cannot accept this verdict. And so he is seduced by the voice of hope, which whispers a comforting lie. The stock is cheaper now. It is a better bargain. Buy more and you will lower your average cost. To the amateur, this feels like a shrewd strategic maneuver. He feels he is taking control of a bad situation. In reality, he is committing financial suicide. Livermore was absolute on this point. Of all speculative blunders, there are few greater than trying to average a losing game. It is to reinforce failure. It is to throw good money after bad. It is to argue with the infallible verdict of the ticker tape. It is a battle that can have only one outcome, the total annihilation of one's capital. His own catastrophic trade in cotton under the magnetic influence of the brilliant Percy Thomas was a textbook example of this very sin. Having been talked into a bullish position against his own better judgment, the market began to move against him. Instead of taking his loss, he listened to hope, and he did more than just hold on. He averaged down. "I simply kept on putting up more and more money," he confessed. More money to lose eventually. He was not just a holder of a losing position. He was actively funding its expansion, digging his own financial grave deeper with every new purchase. The speculator who averages down is a man who is fundamentally misreading the nature of a loss. A loss is not a temporary setback to be endured. It is a clear signal that an error has been made. The professional speculator treats this signal with the utmost seriousness. His first thought is not, how can I make this trade profitable? But how can I exit this trade with the least possible damage to my capital? He understands that his primary job is not to turn every trade into a winner, but to ensure that his losing trades are always small and inconsequential. The 90% do the exact opposite. They are so consumed by the need to be right, so desperate to see their initial opinion vindicated, that they will risk their entire account to avoid the simple professional act of taking a small loss. They will sit with a patience that is almost heroic, a patience they could never muster for a winning trade, and they will watch a small, manageable paper cut fester and grow into a gangrenous, life-threatening wound. This is the great fatal inversion of logic that plagues the amateur trader. He is impatient with his profits and patient with his losses. He is fearful when he is winning and hopeful when he is losing. Livermore's entire philosophy, the very core of his genius, was built upon the conscious and deliberate reversal of this self-destructive instinct. He forged a new professional mindset, a mindset that is the polar opposite of human nature. He taught himself that the time for fear is not when you have a profit, but when you have a loss. When a trade went against him, he did not feel the comforting warmth of hope. He felt cold, rational, and supremely useful fear. He was not afraid of the small loss he currently had. He was terrified of the catastrophic loss it could become. This fear was not a weakness. It was a catalyst for immediate, decisive action. It was the engine that drove his most important rule: cut your losses quickly. And just as he learned to fear his losses, he learned to have hope in his profits. A profit in his eyes was the market's own clear, unambiguous signal that his initial judgment had been correct. He was aligned with the line of least resistance. To abandon a position that had such powerful, tangible validation was an act of strategic cowardice. This was the time for courage. This was the time for a calculated, intelligent hope that the great trend, which the market itself had confirmed, would continue to run its full, logical course. This is the great inversion. Fear your losses and hope for your profits. It is a simple phrase, but it contains the entire psychological secret to speculative success. The 90% do the exact opposite, and that is why they fail. They hope away their losses until they become devastating, and they fear away their profits until they become insignificant. Their ledger is a perfect, tragic reflection of their own inverted emotions. A long list of small, meaningless wins, punctuated by a few all-consuming catastrophic losses. To break this cycle is to wage a war against oneself. It is to have the discipline to sell a losing stock even when the hope of a recovery is at its most powerful. It is to have the courage to hold a winning stock even when the fear of a reaction is at its most intense. It is to understand that the market does not reward hope. It rewards discipline. It does not pay for fear. It pays for courage, the courage to be right and to sit tight. This was the great lesson that Jesse Livermore learned, and it is the only lesson that truly matters. Having now performed a complete and unflinching diagnosis of the two great opposing sins that lead to the amateur's ruin, the fearful impatience that results in winning small, and the hopeful patience that results in losing big, we arrive at the final and most critical part of our study. It is not enough to simply understand the disease. One must possess the cure. The great tragic equation of the 90% is not an immutable law of nature. It can be broken. It can be reversed. Jesse Livermore's entire career, his great comebacks from the abyss of total bankruptcy, were a testament to this fact. He did not just understand the solution. He forged it in the fires of his own devastating failures into a complete, disciplined, and powerful system of action. This is that solution. It is a two-part mechanical and psychological framework designed to systematically dismantle the amateur's flawed instincts and replace them with the cold, hard, and profitable logic of the professional. It is a system that, by its very design, forces the speculator to lose small and empowers him to win big. It is the practical application of the great inversion, the bridge that leads from the world of the 90% to the world of the 10%. The first pillar of this solution is the unwavering, mechanical, and ruthless enforcement of small losses. The tendency to lose big is born of a single corrosive emotion: hope. The only way to defeat this powerful internal enemy is to remove it from the equation entirely. Livermore did this by treating the act of taking a loss not as an emotional decision to be debated, but as an automatic, non-negotiable business procedure. The tool for this was the stop loss. The 90% view the stop loss as a pessimistic act, an admission of potential failure. The 10%, the professionals, understand it for what it truly is: the ultimate tool of survival, the single greatest instrument of capital preservation ever devised. Livermore knew that a speculator's capital is his lifeblood. To protect it was his first and most sacred duty. The stop loss was his shield, the mechanism that ensured that no single mistake, no single flawed judgment could ever deliver a fatal blow. To reverse the equation, the speculator must make a solemn vow. Every single trade will have a predetermined, absolute, and unchangeable exit point for a loss. This is not a mental stop to be argued with in the heat of battle. It is a hard, mechanical line in the sand. When the price crosses that line, the trade is over. There is no discussion. There is no hope. There is only the swift and immediate execution of a pre-made rational decision. This is the mechanical antidote to the poison of wishful thinking. This is the practical application of fearing your losses. The stop loss is the embodiment of that healthy, rational fear. It is the acknowledgement that a small loss, if left unattended, has the potential to grow into a monstrous, account-destroying disaster. By acting on that fear immediately, by accepting the first small loss, the speculator insures himself against the catastrophic loss. He is not just cutting a trade, he is performing a vital surgical procedure, removing a small cancer before it can metastasize and kill the patient. This brings us to the second pillar of the solution, the great offensive strategy that allows for big wins. Having solved the problem of losing big through the ironclad discipline of the stop loss, how does the professional solve the problem of winning small? He does it by applying Livermore's most powerful wealth-building technique, the science of pyramiding. This is the practical application of having hope in your profits. It is the engine that turns a correct decision into a life-changing fortune. The professional does not make one single large bet. He begins, as Livermore did, with a small probe. If that probe shows a loss, it is cut immediately, as per the first pillar. But if it shows a profit, it is the market's own confirmation that his judgment is correct. This is not a signal to take a small profit. It is a signal to press his advantage. He then adds to his position, but only at a higher price. He is averaging up, reinforcing success, his commitment growing only in proportion to the market's own validation. This is the great secret to winning big. The pyramid, by its very design, ensures that the speculator's largest commitment is only ever made when he is already in a position of significant profit. The market itself is financing his increased exposure. The fear that cripples the amateur and forces him to sell too soon is replaced by a profound, evidence-based confidence. The professional has the courage to sit tight, to ride the great primary trend, not because he is a reckless gambler, but because his position has been built upon a foundation of proven, confirmed, and mathematically sound success. This two-part system, the ruthless mechanical defense of the stop loss and the courageous, disciplined defense of the pyramid, is the great solution. It is the machine that reverses the fatal equation. The stop loss forces the losses to be small. The pyramid allows the wins to become big. Over time, the ledger of the speculator who follows this path will begin to look entirely different. It will be a record of many small, insignificant, and professionally managed losses, punctuated by a few glorious and truly magnificent wins. The great wins will pay for all the small losses, and for a great deal more besides. This is the difference. The 90% are trying to be right on every single trade, and in their quest for perfection, they are destroyed by their own emotions. The The 10% understand that they will be wrong many times, and they have built a system that ensures their mistakes are always cheap and their successes are always monumental. They are not in the business of being right. They are in the business of making money. This was the final, profound lesson of Jesse Livermore's career. It is the only lesson that truly matters. To truly learn from a master's mistakes without paying the $1 million tuition fees yourself, there is no greater tool than immersing yourself in his story. Edwin Lefebvre's timeless masterpiece, Reminiscences of a Stock Operator, is more than a book. It is the closest thing a speculator can get to a flight simulator for the human mind. In its pages, you do not just read about Jesse Livermore's triumphs and disasters, you live them. You feel the gut-wrenching pain of his greatest blunders and the quiet, profound satisfaction of his most brilliant campaigns. For those truly committed to this deep study, we highly recommend the edition, which includes a unique, detailed chapter-by-chapter analysis by Max Davidson. This analysis acts as your co-pilot, translating the century-old wisdom of the text into a clear, actionable roadmap for the modern trader, ensuring that the lessons learned in 1923 are as powerful and as profitable today as they were then. A link to this essential edition is provided in the description below. For every speculator, from the novice staring at his first chart to the seasoned professional managing a great fortune, there is one question that precedes all others, a question upon which the fate of all capital rests. When is the right moment to buy? To answer this question incorrectly is to enter the market on a foundation of hope, to place a bet against the great, impersonal probabilities, a path that almost certainly leads to ruin. The amateur answers this question with an impulse, a guess, or a whispered tip. He is a creature of emotion, forever chasing a market that seems to be one step ahead. But the master does not guess. He does not hope. He has a process. Jesse Livermore, the greatest speculator of his time, knew that a perfect entry point was not a matter of luck, but the logical and inevitable conclusion of a rigorous, sequential, and disciplined test. He did not search for opportunities. He waited for them to prove themselves to him. He understood that a successful trade is not a single brilliant action, but a campaign, and a successful campaign begins with meticulous preparation. He developed, through a lifetime of costly trial and error, a mental checklist, a 5-step test that every potential trade had to pass before he would risk a single dollar of his capital. This is that test. It is a simple, powerful, and timeless guide for navigating the most critical decision any trader will ever make. It is a framework for moving from the chaotic noise of the market to the quiet confidence of a high-probability setup. It is a plan that forces the speculator to replace his own flawed emotional impulses with the cold, hard, and objective verdict of the market itself. To follow this 5-step plan is to stop gambling and to start operating a serious, professional, and potentially profitable business. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The entire test, the very foundation of this professional approach, begins not with a stock, not with a sector, but with a panoramic view of the entire market. Step 1. You must assess the general market trend. This was Livermore's first and most sacred commandment. He knew with an unshakable certainty that the individual stock, no matter how promising its own story, is ultimately a ship sailing on the great ocean of the overall market. To attempt to sail north in a hurricane blowing south is not an act of courage. It is an act of suicide. He learned this lesson early and often. The vast majority of his greatest and most profitable campaigns were conducted in perfect harmony with the market's great primary trend. The big money, he insisted, is not in the individual fluctuations, but in the main movements. That is, not in reading the tape, but in sizing up the entire market and its trend. His first job, therefore, was always to determine the direction of this great underlying tide. Was he in a primary bull market or a primary bear market? This was not a matter of a simple guess. It was a careful and dispassionate diagnosis of conditions. He would study the flow of money, the state of credit, and the health of the nation's great industries. But above all, he would study the action of the market itself. Was the general list of stocks making a series of higher highs and higher lows? Was the market absorbing bearish news with ease, a sign of underlying strength? Or was it failing to rally on bullish news, a sign of profound internal weakness? The tape, he knew, was the ultimate barometer of the market's health. The beginner's first and most important rule, then, is to learn to wait with the patience of a master until a great and powerful bull market is undeniably underway. He has no business trying to catch the bottoms of a bear market or navigating the treacherous whipsawing currents of a sideways market. His only game, the only arena where the odds are overwhelmingly in his favor, is the long side of a confirmed primary uptrend. If this condition is not met, the test stops here. The most profitable action is to do nothing. With the great strategic direction established, he would then turn to the second, equally critical question. Step 2. You must identify the leading industry group. Livermore knew that even in the strongest bull market, not all stocks advance equally. The great upward force of the trend is never evenly distributed. It is always concentrated with a ferocious intensity in a select few industry groups. These are the leaders, the generals of the market army, the sectors that are the very engine of the entire advance. He wrote with the clarity of a man stating an undeniable law. As they go, so goes the whole market. His strategy was to focus his capital and his analytical firepower exclusively on these leading groups. To spread oneself thin across the entire market, to have an interest in a dozen different sectors, was to invite confusion and to guarantee a mediocre result. It is much easier to watch a few than many, he insisted. The path to extraordinary profits was through concentration, not diversification. Livermore was a master at observing the result of market forces, the clear established trend on the tape. But to understand the engine driving that trend, we can turn to one of his great contemporaries, a man who dedicated his life to mapping the market's internal mechanics, Richard Wyckoff. While Livermore was the supreme practitioner, the intuitive genius of the tape, Wyckoff was the master analyst who codified the science of accumulation and distribution, the great campaigns by smart money that create the very bull and bear markets that Livermore traded. Livermore saw the wave, Wyckoff explained the currents beneath. If you want to understand not only how Livermore traded, but why the market behaves the way it does from the inside out, subscribe to our new channel, Richard Wyckoff Trading Methods. There we dissect the logic of supply and demand in detail. The link is in the description below. The leading group, like the primary trend, is not a matter of opinion. It is a fact, revealed by the action of the tape. The leading group is the one that emerges from a market correction first and with the most explosive force. It is the one whose component stocks are the first to make new highs. It is the one that shows the greatest percentage gains and the most sustained aggressive buying. Its leadership is a visible, tangible thing to the trained observer. The beginner's task is to learn to see this. He must train his eye to look for this concentrated strength, to ignore the siren's call of the weaker, lagging groups that seem cheaper or due for a move. A stock in a weak group, even in a great bull market, is a ship trying to sail with a broken mast. A stock in the leading group, however, is a modern vessel with the full force of the wind and the tide at its back. This second step of the test, then, is a process of radical focus, of eliminating the 90% of the market that is mediocre to concentrate on the 10% that is truly dynamic. Having completed the first two strategic steps of the test, the speculator has achieved a level of clarity that eludes the vast majority of market participants. He has confirmed that the great primary tide of a bull market is at his back, and he has identified the single strongest fleet, the leading industry group, that is sailing most powerfully upon that tide. He is no longer lost in the vast, confusing ocean of the general list. His focus is now concentrated, his purpose clear. But the test is not yet complete. The next steps are the most refined. The tactical maneuvers that narrow the focus from the leading fleet down to the single flagship and then to the precise psychological moment to board her. This brings us to the third and most crucial step in the selection process. Step 3. You must select the leader within the group. This is the final and most powerful filter, the step that separates the good from the truly great. Even within the strongest and most dynamic industry group, not all stocks are created equal. There will always be one or two undisputed generals, the true leaders that move first, advance fastest, and demonstrate the most profound and resilient strength. The other stocks are mere soldiers in the ranks, following the commands of their leaders. The professional speculator is interested only in the generals. The amateur, in his perpetual and misguided quest for a bargain, almost always makes a fatal error at this juncture. He sees the leading stock, which has already had a substantial advance, and he deems it too expensive. He looks instead for the laggard in the same group, a stock that has not yet moved, and he buys it, believing it is a safer and more logical purchase. He thinks to himself, this stock is in a strong group and it hasn't moved yet. It is due to catch up. This, Jesse Livermore knew, was a profound and fundamental misreading of the market's language. A laggard is not a bargain, it is a weakling. Its failure to advance in concert with its stronger brethren is not a sign of a pending opportunity. It is a profound and glaring warning signal. It is the market's own clear announcement that there is some unseen internal flaw, some hidden source of distribution or some fundamental problem that is preventing the stock from participating in its group's prosperity. Livermore stated it as a core principle, learned through years of costly experience. Experiences had taught me to beware of buying a stock that refuses to follow the group leader. The professional does not buy weakness, hoping it will turn to strength. He buys proven, demonstrated strength, and he is willing to pay a premium for it. His task is to identify the leader. The leader is not a matter of opinion. It is a fact proven by its behavior on the tape. The leader is the stock that moves first. It is the one that makes the largest percentage gains on the highest volume. It is the one that acts right. It absorbs profit-taking with an ease that is almost contemptuous. It feels strong, vital, and alive. It is the stock that everyone is watching, the one that is making the headlines. Livermore's great campaign in the steel stocks was a perfect illustration of this principle in action. He was bullish on the entire group, but he did not buy all the steel stocks equally. He began by testing both U.S. Steel and Utah Copper. From the very first day, U.S. Steel acted like a true leader, moving with power and purpose. Utah Copper, in contrast, was sluggish and unresponsive. Heeding the tape's clear verdict, he concentrated his full financial firepower on the proven leader, U.S. Steel, while leaving the laggard alone. This single disciplined decision was the key to one of his most profitable campaigns. With the undisputed leader of the leading group now clearly identified, the test arrives at its fourth and most psychologically demanding step. Step 4. You must time the entry with a pivotal point. This is the great and final challenge of the analytical phase. The speculator now has the right market, the right group, and the right stock. But all of this brilliant work is for naught if his timing is flawed. To be correct in your analysis but premature in your action is to invite a slow and agonizing financial death. You will be whipsawed by meaningless fluctuations. Your capital and your nerve eroded long before the real profitable move ever begins. Livermore knew more than any other trader that timing was everything. He wrote, "Much depends upon beginning at exactly the right time. It took me years to realize the importance of this. It also cost me some hundreds of thousands of dollars. The amateur is consumed by impatience, by a frantic need to be in the market. The professional, in contrast, must cultivate the supreme and difficult art of waiting. He must sit, sometimes for days, sometimes for weeks, his capital held in reserve, until the market itself gives the final, unequivocal signal that it is ready to move. This signal for Livermore was the decisive breach of a pivotal point. This was his psychological moment, the point in time and price where the long period of quiet preparation was over, and the public marking up phase was about to begin. For the beginner following this plan, the simplest and most powerful pivotal point to watch for is the moment a leading stock makes a new high after a period of consolidation or a natural, healthy reaction. It is only at this precise juncture and not a moment sooner that the first commitment should be made. His legendary campaign in Bethlehem Steel was the ultimate testament to this discipline. For 6 long weeks he watched the stock climb, his bullish conviction growing stronger with every passing day. He saw it move from the 50s to the 80s to the 90s. Every point of advance was a siren's call to his impatience. The amateur would have jumped in a dozen times, but Livermore waited. He was not interested in the preliminary skirmishes. He was waiting for the main event, the signal that the great public advance was about to begin. That signal, for him, was the breach of the great pivotal point at $100. The moment it was crossed, he acted, and in doing so, he entered one of the greatest trades of his career. This is the great challenge. To sit idly by to watch a stock that you know is a leader climb higher and higher requires a level of self-control that few possess. But it is this very discipline that separates the professional from the amateur. The professional is not paid for trading. He is paid for being right. And being right requires waiting for the one single moment when the probabilities are overwhelmingly in your favor. With the completion of this fourth step, the entire analytical phase of the campaign is over. The speculator has successfully navigated the great top-down filtration process. He has confirmed the primary trend of the market. He has identified the leading group. He has selected the strongest stock within that group. And he has had the supreme patience to wait for that chosen stock to arrive at its own perfect psychological moment to act. He has now done everything in his power to tilt the odds in his favor. He is now, and only now, ready to proceed to the final tactical step of the test. The execution of the trade itself. This is the step that bridges the gap between a brilliant analysis on paper and a tangible profit in the account. It is the science of committing capital, the tactical execution of the campaign plan. The amateur, in his excitement and greed, sees the buy signal and rushes in with his entire stake at once. He goes all in, a single heroic bet. This, Livermore knew, was a strategic blunder of the highest order. It maximizes risk at the precise moment of entry, making the entire campaign vulnerable to a single adverse fluctuation. The professional does not act this way. He moves with the calculated precision of a general, committing his troops to a battle, one battalion at a time. This brings us to the core of Livermore's execution strategy, the probe. He would never, under any circumstances, take his full intended line at the initial entry point. His first move was always a small exploratory commitment, perhaps 1/4 or 1/5 of his total intended position. This was not the main assault. It was a reconnaissance mission. Its purpose was singular, to ask the market one final practical question, with real money on the line. Am I right, and is the time right now? The market's answer to this probe was immediate and binary, and it governed all subsequent action. This is where Livermore's #1 rule for every trade came into play. The probe must show a profit almost immediately. An immediate profit was the market's own final and irrefutable confirmation that the entire 4-step analysis had been correct. It was a green light of the highest order, a signal that the line of least resistance was clear, and the great advance was truly underway. If, however, that initial small probe immediately resulted in a loss, it was an equally clear signal. It was the market's final verdict that, despite all the careful preparation, the timing was flawed. The resistance was greater than anticipated. The move was not yet ready. In this scenario, the rule was absolute. The position was to be closed out immediately. the small predetermined loss accepted without question or regret. The entire 5-step test was now invalid, and the speculator would return to a position of cash waiting for a new, more opportune moment. This is the great defensive genius of the method. The first commitment is small, and the loss, if it comes, is therefore insignificant. It is a small tactical retreat, a cheap price to pay for the invaluable information that you are wrong. It is this discipline that separates the professional who lives to fight another day from the amateur whose all-in bet, if mistimed, can cripple his entire campaign from the very start. But what if the probe is successful? What if the initial commitment does in fact show a quick and decisive profit? This is where the second and more aggressive phase of the entry method begins, the science of pyramiding. Having been proven right by the market, the speculator's job is now to press his advantage. He will now add the second, third, and fourth parts of his intended line, but only under a set of strict, unwavering conditions. The first condition is the most important and the most contrary to the amateur's instincts. Each succeeding purchase must be at a higher price than the one before it. This is the art of averaging up, the polar opposite of the amateur's cardinal sin of averaging down. The professional does not reinforce failure. He reinforces success. To buy more of a stock as it advances is to add to a position that the market is actively proving to be correct. You are not buying an expensive stock. You are buying a stock that is demonstrating its own profound, undeniable strength. The logic is unassailable. The first probe was a success. The second purchase at a higher price is a bet on that success continuing. If that too is profitable, the third purchase is made with even greater confidence. The speculator is building his position on a rising scale, his commitment growing only in proportion to his proven success. His largest and final commitment is made only when the trade is already a significant winner, when his initial judgment has been validated by the market not once but multiple times. Throughout this process, his risk is being methodically managed. With each new addition to the pyramid, the stop-loss is trailed upward. As in the famous system of the great gambler Pat Hearn, the stop is moved to just below the price of the most recent purchase. This powerful mechanical trick achieves a remarkable result. It systematically locks in the profits of the earlier commitments, often making the entire, now substantial position virtually risk-free. The speculator is, in a very real sense, letting the market's own profits finance his increased exposure. This, then, is the complete 5-step test for a perfect entry. It is a journey that moves from the broadest strategic assessment down to the most precise tactical execution. Step 1. You confirm the great primary trend of the market. Step 2. You identify the leading industry group. Step 3. You select the single undisputed leading stock within that group. Step 4. You wait, with the supreme patience of a master, for that stock to reach its own precise pivotal point for action. And Step 5. You execute a gradual entry, beginning with a small probe, and pyramiding your position only on the market's own confirmed and profitable validation. To follow this checklist is to transform speculation from a frantic emotional gamble into a calm, disciplined, and professional business. It leaves nothing to chance, nothing to hope, and nothing to fear. It is a systematic process for ensuring that when you finally do commit your capital in a significant way, you are doing so in the right market, with the right stock, at the right time, and in the right way. This is not a guarantee of profit on any single trade, for speculation can never be made entirely safe. But it is the closest thing a man can get to a guarantee of long-term, consistent success. It was the foundation of Livermore's greatest victories, and it remains the only true path for the speculator who is serious about his craft. To truly understand the mind of the man who forged these principles, to witness the epic market battles where this very plan was put to the ultimate test, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book, it is a deep psychological portrait of a master at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. It is the great, enduring paradox of Wall Street. In an arena of immense, almost unimaginable wealth creation, the vast majority of participants are destined to lose. Why is it that in a game with seemingly even odds, a game of ups and downs, that 90% of all who attempt it are systematically and relentlessly separated from their capital? The answer to this profound question is not found in complex algorithms or secret insider knowledge. It is found in a simple but fundamental difference in mindset, a deep and unbridgeable chasm that separates the thinking and the actions of the losing 90% from the disciplined professional 10%. Jesse Livermore stood with a foot in both of these worlds. He knew the intoxicating highs of the winning minority and the soul-crushing lows of the losing majority more intimately than any man who has ever played the game. He made and lost colossal fortunes, and in this brutal, repetitive cycle of victory and ruin, he discovered the timeless laws that govern speculative success and failure. He saw, with the clarity of a man who had paid the ultimate price for his education, exactly what the 10% do right and what the 90% do wrong percent, with a tragic and predictable consistency, do wrong. This is not a story of luck or of genius in the conventional sense. It is a story of a great psychological divide. It is an examination of two sides of trading, two fundamentally different approaches to the same great game. On one side stands the professional, the cold, calculating student of conditions, a man who treats speculation as a serious business. On the other stands the amateur, the hopeful, emotional plunger, a man who treats the market as a great casino. The difference in their results is not a matter of chance. It is the certain and inevitable consequence of their opposing philosophies. The first and most foundational error of the losing 90% is that they treat speculation as a gamble. They come to the market not to engage in a serious business enterprise, but to get rich quick. They are drawn in by the allure of easy money, by the thrilling tales of fortunes made overnight. They are, in essence, playing the lottery, their actions guided not by a reasoned analysis of probabilities, but by a raw, undisciplined hope. Livermore knew this mindset was a death sentence. He stated with the cold finality of a judge that the market is not a game for the get-rich-quick adventurer. They will die poor. The gambler's mindset manifests in a complete disregard for process. He does not study. He does not prepare. He does not have a plan. He operates on impulse, on a hot tip from a friend, on a headline in a newspaper, on a gut feeling. He's a creature of the moment, his decisions erratic and inconsistent. He is what Livermore called the Wall Street fool, the man who thinks he must trade all the time. He has a constant, anxious hankering for activity, believing that to be out of the market is to be missing the action. The professional 10%, in stark contrast, understand that speculation is a business, and it is a hard and trying business at that. It requires hard study and clear thinking. The successful speculator is not a man who is constantly trading. He is a man who is constantly waiting, with the patience of a predator, for the rare, high-probability setups that are the only legitimate targets of his capital. He knows that the vast majority of the time the correct course of action is to do nothing, to sit in cash and allow the market to declare its own intentions. The 90% lose because they are impatient. The 10% win because they are patient. The second great and fatal flaw of the 90% is that they are utterly and completely ruled by their emotions. Their trading accounts are not a reflection of their intellect, but a direct printout of their hopes and their fears. Livermore saw this as the great central battle of the speculative game. The speculator's chief enemies, he warned, are always boring from within. These enemies are not the market makers or the insiders. They are the primal, powerful, and deeply human emotions of greed, fear, and most destructive of all, hope. The 90% have their emotional responses to the market perfectly, fatally inverted. When a trade is going in their favor, when they have a small paper profit, they are consumed by fear. They are terrified that the market will take back their fragile winnings. This fear compels them to sell too soon, to snatch a meager profit from a move that may have 100 points yet to run. They are afraid when they should be at their most confident and courageous. Conversely, when a trade is going against them, when they are facing a loss, they are not fearful. They are filled with a desperate, paralyzing hope. They hope the market will turn around. They hope their stock will come back. This hope is a siren's call, luring them deeper and deeper into a losing position. It is this hope that fuels the cardinal sin of averaging down, of throwing good money after bad. The 90% are hopeful when they should be terrified. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles. A place you can return to not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. The winning 10%, as Livermore discovered, have learned to perform a profound act of psychological alchemy. They have learned to invert their own natural instincts. They feel fear when a trade shows them a loss, a rational fear of a greater loss, and this fear drives them to cut the position immediately. They feel a courageous, intelligent hope when a trade shows them a profit, a hope that this is the beginning of a great move, and this hope gives them the patience to sit tight and let it run. The 90% are destroyed by their emotions, the 10% profit by mastering them. The third great flaw of the losing 90% is that they are perpetually arguing with the market. They are ruled by their own opinions, by their own egos need to be right. When they buy a stock and it goes down, their first conclusion is not that their judgment was wrong, but that the market is wrong. They see the ticker tape not as an infallible judge, but as a personal adversary that must be fought and conquered. Livermore knew this to be a form of madness. His entire philosophy was built upon a foundation of profound intellectual humility before the market. His most famous and important maxim was this: markets are never wrong, opinions often are. The price action on the ticker tape was, for him, the final and absolute truth. It was the sum total of all the knowledge, all the hopes, and all the fears of every participant in the market. To argue with it was to argue with a force of nature. The 90% cannot accept this. Their ego is too deeply invested in their own opinion. And so they fight the tape. They hold on to a losing position, not because of a reasoned analysis, but because to sell would be to admit a mistake. They average down, not as a strategy, but as an act of defiance. They are, in effect, trying to impose their will upon the market, an exercise in futility that can have only one outcome: the complete depletion of their capital. The winning 10%, in contrast, have no ego in their trading. Their only loyalty is to being on the right side. The moment the market proves them wrong, they do not argue. They do not get angry. They do not hope. They act. They close their position, accept the small loss, and move on. They understand that a single trade is but one of 1,000, and that the outcome of any individual venture is insignificant compared to the long-term preservation of their capital and their mental equilibrium. The 90% are destroyed by their need to be right. The 10% prosper by their willingness to be wrong. Having thoroughly dissected the flawed mindset and the self-destructive habits of the losing 90%, we now cross the great divide. We move from the world of the amateur to the world of the professional, from the realm of the gambler to the serious business of the master speculator. What then does this winning 10% do right? What are the core principles, the foundational habits of thought and action, separate them so completely from not a secret formula, but a profound and disciplined commitment to a different way of thinking, seeing, and acting in the market. The first and most fundamental difference is this. The winning 10% treats speculation as a serious business. Where the amateur sees a casino, a thrilling game of chance, the professional sees a complex business enterprise that demands intense study, careful planning, and a rigorous unemotional execution. He is not in it for the excitement or the quick thrill of a lucky bet. He is in it to make a consistent and substantial living, and he approaches his work with the same seriousness as a surgeon entering an operating room or an engineer designing a bridge. This business-like approach begins with a commitment to education. The professional understands that to succeed he must learn and understand the market to the best of his ability. He is a lifelong student, a tireless researcher of conditions, of historical precedents, and of the unchanging patterns of human psychology. Jesse Livermore himself, even at the height of his success, was in a constant state of study, always seeking to refine his methods, always looking for a new edge. He knew that the moment a speculator stops learning is the moment he begins to fail. The 90% are too lazy to do this work. The 10% know it is the very price of admission. This business-like mindset also means having a plan. The professional never enters the market on a whim. Every commitment is part of a larger, well-reasoned campaign. He knows his reasons for entering. He knows his point of surrender if he is wrong, and he knows his strategy for maximizing his profit if he is right. The 90% are driven by impulse. The 10% are guided by a plan. They are not reacting to the market's every move. They are executing a predetermined strategy. The second great principle of the winning 10% is that they are masters of their own emotions. Where the amateur is a slave to the primal forces of hope and fear, the professional has learned to invert them, to transform them from his greatest enemies into his most powerful allies. This psychological inversion is perhaps the most difficult and most important skill in all of speculation. It is the very heart of the professional mindset. When a trade is going against him, the professional does not feel the comforting warmth of hope. He feels a cold, rational, and supremely useful fear. He is not afraid of the small loss he currently has, but he is terrified of the catastrophic loss it could become. This fear is not paralyzing. It is a catalyst for immediate, decisive action. It is the engine that drives his most important rule, to cut his losses quickly and without hesitation. The 90% are destroyed by hope. The 10% are saved by fear. Conversely, when a trade is going in his favor, the professional does not feel the anxious grip of fear that his profits will vanish. He feels a courageous and intelligent hope. This is not the blind hope of the gambler, but a calculated confidence based on the market's own confirmation that his judgment is correct. This hope gives him the fortitude to sit tight, to ride a winning position through its minor, nerve-wracking reactions, in pursuit of the great sweeping move where the real money is made. The 90% are cheated out of their fortunes by fear. The 10% achieve them through hope. This mastery of emotion allows for a level of detachment that the amateur can scarcely comprehend. To the professional, a trade is not a personal battle. A loss is not a reflection on his intelligence. It is a simple business expense. A win is not a mark of his genius. It is the logical outcome of a well-executed plan. This dispassionate approach keeps his mind clear and his judgment unclouded, allowing him to see the market as it is, not as he wishes it to be. The third and final great principle of the winning 10% is that they obey the market with absolute fidelity. Where the amateur in his ego argues with the tape and insists that his own opinion is supreme, the professional has a profound and unwavering respect for the market's verdict. He knows, with a certainty born of experience, that markets are never wrong, opinions often are. The ticker tape is the final and only truth, and its judgment must be accepted without question. This means the professional has no loyalty to the bull side or the bear side. His only allegiance is to the right side. He is not concerned with proving his own predictions correct. He is concerned only with aligning his capital with the great underlying line of least resistance. When the market tells him he is wrong, through the simple, unambiguous language of a price moving against him, he does not hesitate. He does not wait for a reason. He acts. He understands that to fight the tape is to fight an irresistible force. His job is not to conquer the market, but to flow with it. This requires a supreme level of intellectual flexibility, the ability to change one's mind in an instant when the evidence changes. The 90% are destroyed by their stubbornness, by their emotional commitment to a position that the market has already proven to be a mistake. The 10% prosper because they are nimble, because they can admit an error without it damaging their ego, and because they can pivot their position in perfect harmony with the market's ever-changing tune. These three great principles, then, are the dividing line between the two sides of trading. On one side stands the 90%, the gamblers, the hopeful, the emotional, the impatient, the men who believe their own opinions are more powerful than the market itself. On the other side stands the 10%, the businessmen, the students, to listen to the market and to obey its commands. To cross this divide is the great challenge of every aspiring speculator. It is a journey that requires more than just capital and a desire to win. It requires a complete and total reconstruction of one's own mind. It is a commitment to the difficult, often painful work of self-mastery. It is the understanding that the greatest enemy is not the market, but the flawed, impulsive, and deeply human nature that resides within. To truly understand the mind of the man who crossed this divide more spectacularly than any other, to witness the epic market battles where these principles were forged in the crucible of real-world profit and loss. The essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the operational summary of a lifetime of market lessons. To understand the full epic story behind each step, the painful losses that created them and the epic victories they enabled, the essential pilot's logbook remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. The entire process begins not with a stock, not with a chart, but with a broad, sweeping assessment of the entire market. The first and most important step on the checklist is this. Step 1. Assess the general market trend. Before he ever considered buying or selling a single share of any company, Livermore had to have a clear, unwavering conviction about the direction of the primary market current. Was he in a great bull market or a great bear market? This was the foundational question upon which all subsequent decisions would rest. He knew, with the certainty of a man who had been bankrupted by ignoring this very rule, that the big money must necessarily be in the big swing. He was not interested in playing for small, nervous reactions against the primary trend. That was a game for suckers, a certain way to be ground down by commissions and whipsaws. His goal was to identify the great underlying tide, the line of least resistance, and to set his sails in perfect harmony with his powerful, irresistible flow. To fight this trend, he believed, was a form of insanity. He stated it as a simple, almost childishly obvious truth. The thing to do was to be bullish in a bull market and bearish in a bear market. Yet, he saw traders violate this principle every single day. They would try to short stocks in a roaring bull market simply because the prices seemed too high. or they would try to buy bargains in the midst of a collapsing bear market, hoping to catch the bottom. These were not acts of courage. They were acts of ego, of a man pitting his own small opinion against the market's gigantic impersonal force. This first step required patience and study. It was not a guess, but a diagnosis based on a careful analysis of general conditions. He would study the money supply, the state of credit, and the health of the nation's key industries. He would observe the market's own behavior, its reaction to news, its ability to absorb selling, or its failure to sustain rallies. He would wait, sometimes for months, until the character of the market was unmistakably clear to him. Only then, with a firm conviction about the primary trend, would he proceed to the next step. With the great strategic direction established, the checklist moves to the next level of filtration. Step 2. Identify the leading industry group. Livermore knew that even in the strongest bull market, not all stocks advance equally. The great power of a primary trend is always concentrated in a few select industry groups. In his day, it was the railroads, then the steels, then the motors. These were the generals, the vanguard that led the entire market army. As they go, he said, so goes the whole market. His rule was to confine his studies and his capital to these prominent leading groups. To spread oneself thin across the entire list, to have an interest in a dozen different sectors, was to invite confusion and mediocrity. It is much easier to watch a few than many. He had a handful of groups that were demonstrating the most profound strength. He dramatically increased his odds of success. He was not looking for a needle in a haystack. He was looking for the most powerful locomotive at the head of the fastest train. The leading group was not a matter of personal preference or fundamental analysis alone. It was a fact, proven by the action of the ticker tape. The leading group was the one that rallied first and strongest after a market correction. It was the one that made new highs with the greatest ease. It was the one that showed the most resilience to selling pressure. Its leadership was a visible, tangible thing to the trained observer. This second step, then, acts as a powerful filter, narrowing the speculator's focus from the entire market down to the single sector where the greatest opportunities reside. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Having identified the market's strongest battalion, the checklist demands an even greater level of zoom, believing it is due to catch up. Livermore knew this to be a fatal and fundamental error. A laggard, he understood, is not a bargain. It is a weakling, and it will turn to strength. His rule was absolute. Concentrate your... The leader is identified by its behavior on the tape. It is the stock that moves first. It is the one that makes the... It is the one that acts right. It absorbs profit-taking with an ease that is almost contemptuous. It feels strong, vital, and alive. It is the stock that everyone is watching, the one that is making the headlines. To buy this stock, even at what seems like a high price, is not an act of chasing. It is an act of aligning oneself with the market's most powerful, concentrated force. His famous campaign in the steel stocks was a perfect illustration of this principle. He was bullish on the entire group, but he did not buy all the steel stocks equally. He began by testing both U.S. Steel and Utah Copper. From Utah Copper, in contrast, was sluggish and unresponsive. U.S. Steel, while leaving the laggard alone. This single, disciplined decision was the key to one of his most profitable campaigns. This third step completes the strategic selection process. The speculator has now moved from a broad assessment of the entire market down to a single high-probability candidate. He has identified the strongest stock in the strongest group in a market whose primary trend is aligned with his intended trade. The odds are now overwhelmingly in his favor, but the checklist is not yet complete. The final tactical steps of timing, risk, and confirmation still lie ahead, the crucial bridge between a brilliant analysis and a profitable trade. Having completed the first 3 strategic steps of the checklist, the speculator has achieved what few amateurs ever do. He has identified the single most promising candidate for a major move in the entire market. He has filtered the universe of stocks down to the leading stock in the leading group, in a market whose primary trend is aligned with his intended trade. The great probabilities are now on his side, but a brilliant analysis is worthless if it is not matched by a flawless tactical execution. The final 4 steps of the checklist are designed to govern this critical phase, to bridge the vast and treacherous gap between a sound idea and a profitable trade. This brings us to the 4th and perhaps most difficult step of the entire process, a step that tests a man's discipline to its absolute limit. Step 4. Wait for the pivotal point. Jesse Livermore knew that the greatest and most costly mistake in speculation was not being wrong, but being wrong at the wrong time. To be correct in your analysis but premature in your action is to invite a slow and agonizing financial death. You are whipsawed by meaningless fluctuations. Your capital is eroded and your nerve is shattered long before the real profitable move ever begins. He learned this lesson not in theory but in the brutal reality of his own account statement. He stated with the pain of experience in his words, after forming a definite opinion with respect to a certain stock, do not be too anxious to get into it. Wait and watch the action of that stock. He knew that a stock, even one destined for a great advance, must first complete its period of quiet, unseen accumulation. To enter during this phase is to have your capital lie dormant and unproductive, or worse, to be shaken out by the deliberate engineered reactions designed to dislodge impatient holders. The professional speculator, therefore, must have the supreme patience to wait for the market's own signal that it is ready point. This was his psychological moment, the point in time and price where the long period of preparation was over and the public marking up phase was about to begin. It was only at this precise juncture, and not a moment sooner, that he would consider committing his capital. The wait might be days or it might be weeks, but the discipline to wait was non-negotiable. With the market finally arriving at the predetermined pivotal point, the checklist moves to the 5th and critically important step of self-preservation. Step 5. Define your risk. Before placing a single order, before a single dollar is put on the line, the professional speculator must answer the most willing to lose if my judgment is proven wrong. This is not a question to be answered in the heat of battle. It is a cold, calculated decision made in a moment of complete emotional detachment. Livermore treated his capital as a general treats his army's reserves, as a finite and precious resource to be guarded with the utmost seriousness. He wrote, "The speculator has to be his own insurance broker, and the only way he can continue in business is to guard his capital account. The answer to the question of risk, then, is a specific price point, a line in the sand. It is the stop loss, the predetermined point of surrender where the trade is proven to be a mistake and the position must be closed without question or hesitation. To enter a trade without this clearly defined exit point is to engage in a form of financial madness. It is to sail into a hurricane without a rudder, to enter a battle without a plan for retreat. The amateur thinks only of the potential profit. The professional thinks first of the potential loss. By defining his risk beforehand, the speculator transforms a reckless gamble into a calculated business venture. He has controlled the one variable in the entire speculative equation that is completely within his power to control, the size of his own loss. With the trend, the stock, the timing, and the risk all clearly defined, the checklist arrives at the moment of action. Step 6. Execute the initial probe. Even now, with every condition aligned in his favor, Livermore would not charge into the market with his full intended line. He was not a plunger in the reckless sense of the word. His first move was always a test, a small exploratory commitment. He would buy a fraction of his total intended position, perhaps 1/5 or 1/4. This was his final practical question to the market. He had done his analysis, he had waited for his signal, and now he was asking the tape, with his own money, am I right? This method of starting small is a profound principle of risk management. It ensures that if, for some unforeseen reason, his judgment is immediately proven wrong, his loss is kept to an absolute minimum. It is a final cautious step into the water before committing to the full plunge. The amateur in his greed does the opposite. He enters his full position at once, maximizing his risk at the moment of maximum uncertainty. The professional, in his prudence, enters a small position, minimizing his risk until the market has given its final, unambiguous confirmation. This brings us to the seventh and final step of the checklist, the market's own answer to the speculator's probe. Step 7. Demand immediate confirmation. This was, for Livermore, the ultimate and most powerful validation of his entire analytical process. A correctly timed trade, made in a true market leader at a genuine pivotal point, should not hesitate. It should, he insisted, show a profit almost immediately. This was not a desire for a quick scalping gain. It was a demand for irrefutable proof that he was in harmony with the market's immediate line of least resistance. He stated it as one of his most foundational beliefs. Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. An immediate profit was the sign that other buyers were present, that the upward force was real, and that the path was clear for a sustained advance. It was the market's own green light, the final signal that his campaign could proceed with confidence. If, however, the trade immediately showed a loss, it was a red light, an equally clear signal that his timing was flawed. The market was not ready. There was unseen resistance. To hold on to such a trade was to substitute hope for the clear, factual evidence of the tape. The checklist demanded one course of action: exit immediately. Honor the stop loss defined in step 5. Accept the small diagnostic loss and return to a position of cash, waiting for the next, more opportune moment. This 7-step checklist, then, is a complete holistic system for professional speculation. It is a journey that begins with a broad, strategic assessment of the entire market and ends with a specific, tactical, and confirmed trade. It is a process that forces the speculator to move from opinion to analysis, from analysis to a plan, and from a plan to a disciplined, unemotional execution. It leaves nothing to chance, nothing to hope, and nothing to fear. It is a framework that transforms the market from a casino into a business. Each step is a logical and necessary prerequisite for the one that follows. To skip a step, to act out of sequence, is to break the chain of logic and to reintroduce the element of a gamble. By adhering to this checklist, a speculator ensures that he is always trading with great probabilities on his side, that his timing is precise, that his risk is controlled, and that his judgment is confirmed by the only authority that matters: the market itself. This was the source of Livermore's power. It was his roadmap to fortune, a guide that is as true and as essential today as it ever was.